The euphoria around the faster than expected rebound in global economic activity really helped equities in the second quarter. From a global perspective, they've rallied for the fifth consecutive quarter. However, we did start to see some bifurcation across the world. Instead of everybody rallying out of the pandemic, we started to see some areas that were very leveraged to the economic recovery. So for example, as you can see in this chart, Latin America, that tends to be very correlated with commodities. That was one of the best performing areas. The US and Europe, they outperformed some of their other global counterparts, and there was better control of COVID and its variants. However, if you also look, you can see some areas like in Asia and Japan where they're struggling with COVID and its variants, and their vaccination programs have not been as robust as the developed markets. You've seen them lag in the second quarter. Given the expectation that we think that the expansion can continue, and albeit even at a slower pace, we still do favor global equities over bonds. Where we would focus would be in the international developed markets at this time. The international developed markets, as you can see in this chart, just from a valuation perspective, are very cheap versus the US markets. They've lagged over the past decade to the US markets, and they were a little behind the US markets in regards to reopening and getting the vaccines. But now they're reopening. They're vaccinating at levels like we're seeing here in the US, so we think this will benefit the international developed markets. The second factor is that they are also much more levered to the global reopening trade. They're much more cyclical in nature. A lot more of their economic growth is made up of exports, so this should benefit some of the developed international markets over the US markets. Within the US, we still lean towards that reopening trade. Now, we realize that some of the growth and expensive tech sectors did resume some of the leadership in the second quarter. We don't think that's sustainable because they were benefiting from lower interest rates. With our view that interest rates are going to rise, the economy is going to continue to expand, you want to focus on those areas that will benefit the most in that environment. That is your cyclical sectors. That's a value-oriented tilt to your allocation, and it's also the small and mid-cap sectors in the US. And what we've seen over the past couple months in the emerging markets doesn't necessarily deter us for the long term, but we are patient and looking at additional opportunities potentially to enter that space. Right now, we want to see the COVID variants get a bit under control. We want to see their vaccination efforts pick up. These should all benefit economic growth, but until that happens, you're going to see a lot of volatility because confidence on future growth in these areas can be hampered if COVID is running out of control there.